Good evening, ladies and gentlemen. It's a great pleasure to be here. And I'm going to be talking about the Merchants Trust. And before I do that, I'm actually going to talk about something. Well, let me just get the disclaimer out of the way. So I'll let you read that at your leisure in the electronic version. But thank you, we've covered that. I'm going to be talking about the Merchants Trust. But before I do that, something I don't normally talk about is the UK equity market. Is there value? Where can we find value in UK equities? I think with the FTSE at 7,500, we're getting this question a lot. Is there value in the market? Have we seen the best of it? The FTSE's at a record level. Many other markets are at record levels. So is there value today? Should we be investing in equities or should we stick it all in the bank? I haven't got the answer, but what I will do is talk about some of the issues. So the reason I raise this question is because when you look around, there's a lot of uncertainty around in the world. These are some of the issues that are going on. You could call them headlines, but clearly Brexit is a major issue in the UK. You've got all sorts of geopolitical tensions. You've got risks in the Eurozone. You've got inflation picking up. There are a number of risks out there which are unsettling investors. So that's clearly not helpful. On top of that, depending on what you look at, there are certain measures that make stock markets look pretty expensive. So thank you to Morgan Stanley for these graphs, but this first one is the price-to-earnings ratio on the stock market, and we're right up at levels that we haven't seen. This goes back to 1925, so it's quite a long chart. We're right up at levels we've never seen before in terms of the price-to-historic earnings in the market, which suggests that there's not a lot of value out there. And the other chart on the left-hand side is the dividend yield of the market. Again, 3.5%. Although we have seen lower levels than that, we're certainly a long way below the very long-term average. And it suggests, again, there isn't a huge amount of value on that measure. Secondly, returns. Returns are pretty depressed. Companies' returns on equity, how much money they're making on the assets in the business, on the equity invested in the company, they're pretty depressed. And if you look at the profit margins of non-financial companies, again, we are well below long-term averages. So again, the question really is there any value in the stock market? And Merchants Trusts are fully invested in the stock market, so this is a pretty important question. Well, I quite like this quote here, statistics, the science of producing unreliable facts from reliable figures. I thank Evan Esser for that. I think there are many ways of looking at the same information. There are two sides to the coin. So I'm going to present the other side as well, and then you can, I guess, decide whether you think there's any value in the market. So the first thing is that actually profits are extremely depressed. This chart again goes back to 1970, shows the earnings level of the whole market, and we're well below where we were. Or if you look on the left-hand side, the same data shows how far below the long-term average earnings are, or sorry, how far below the previous peak. And earnings are down 60% or so off the previous peak level, which we've never seen before, certainly not since 1970. So earnings are very depressed. And that may seem funny when you look at profits from Unilever and the tobacco companies, which are hitting record highs. But then if you think about the broader UK market, you've got the oil sector, it's a big sector, where profits are depressed because the oil price fell significantly and companies made losses. The banks were still suffering last year from PPI, massive PPI, payment protection insurance claims, which forced some of the banks into losses. Royal Bank of Scotland had a big loss. So big chunks of the stock market, many of the mining companies were not making money. Big chunks of the stock market weren't making money last year. So the earnings base of the market is depressed. And clearly you shouldn't really value companies off 1 year's depressed earnings. And many of these factors are starting to reverse out. The second thing I would say is that if you then look at normalized valuations, so if you try and smooth the earnings of businesses, you get a very different picture. There's something called the Schiller PE from Professor Schiller, which takes the last 10 years average earnings of companies and looks at today's price compared to the last 10 years average earnings. That's this chart on the left. And if you look at market valuations on that basis, they're much more reasonable. Companies are nowhere near as expensive if you compare them to the average of the last 10 years earnings rather than just last year on its own. Similarly, if you look at price to book value, we've got a chart going back to 1975. We're actually trading bang on the average level. in terms of the amount you pay for a company compared to its asset value. It's true, if you go back a bit further than that, we're paying more today for the assets of companies than we would have been doing 50, 60, 70, 80 years ago. But many companies make a lot more money out of intangible assets, out of technology, out of people, out of software, which don't have the same physical assets. Historically, most businesses were very asset intensive, whether you're building ships or coal mining or whatever you're doing. There was a lot of capital involved. There's less capital involved in many businesses today. So you would expect to pay a higher multiple on average for the book value, for the physical value of a company today, physical assets, than historic. So the fact that we're at average value for the last 40 years or so, I think that's actually pretty good. So that's a tick in the box, if you like. And then thirdly, and this is a bit more anecdotal, I'm afraid, but when I look around at the market, I do find plenty of cheap shares. I think valuations are really dispersed. There are companies that are quite depressed, and the share prices are low and offer good value. And there's other companies, some of the bond proxies, you may have heard that phrase used, some of the big tobacco, food companies like Compass, Bunzl, Reed Elsevier, very strong, reliable businesses. Those are quite highly rated. But many more cyclical businesses, maybe the big oil companies, some of the banks, are on quite modest ratings. So there's a big diversion out there. And we can find good value in some of the mega caps, some of the recovery stocks. And so that's quite interesting. And then if you compare equities to other class assets, if you say, well, if I don't own equities, what am I going to own? Well, if you own government bonds, you get a very low return. At the moment, and the chart on the right takes the dividend yield on the market and takes away the yield on bonds. And for most of my career, and this goes back to 1930, for most of my career, and for most of my life actually, but certainly for most of my career, government bonds yielded a lot more than equities. The idea was that you take a lower yield on equities, but that dividend grows over time, and therefore you make a better return. And that was called the reverse yield gap. If you go back far enough, before the 1950s, bonds tended to yield more than equities. Sorry, equities tended to yield more than bonds. Many investors at that time thought equities are risky, shares are risky. You're buying companies, profits can go up and down. There's all sorts of risks, and you need a higher return, a higher dividend, a higher income from shares to justify that extra risk. The thinking changed, as I say, for about 60, 70 years. But now we're back in the situation, once again, where equities yield more than bonds. And I think it's driven by a very different thing this time around. It's driven by central banks buying bonds, pushing bond yields down to extremely low levels and cutting interest rates to extremely low levels. What this chart tells me really is that bonds are actually very pricey. It may say less about equities, but it certainly says if you compare equities to bonds, equities which yield more than bonds are very interesting because you should get dividend growth. You should get real growth from companies in the long term. And I've put here what happened to the reverse yield gap because it's gone away again. And that's quite interesting and quite unusual. So the other thing I would say is, talking about the uncertainty at the beginning, there's an old phrase that equities tend to climb a wall of worry. When people are really worried about things, really worried about politics and economics and Brexit and things like that, a lot of that bad news is often discounted in shares, is priced into shares. And as people gradually come to terms with some of those issues, shares can often climb this wall of worry. Now, I want to be absolutely clear. I'm not predicting the market's going to go well. I'm not predicting it's going to go up. I'm not actually saying it's going to go down. I don't have a very strong view where the market's going to go in the short term. But I think there's plenty of arguments that the equity market in aggregate is reasonably valued, certainly compared to the cost of money, the cost of debt. And when I look at individual companies, as I'll come on to in a minute, I find plenty of opportunities. That's just setting the scene for the stock market. I'm now going to turn to Merchants Trust, which is an investment trust I'm very honoured to manage. It's been going since 1889, so it's been around a long time. We have a dividend yield of 5% to shareholders, and the board of directors has raised the dividend every year for the last 35 years. We are one of the Association of Investment Company Dividend Heroes of raising dividends every year for at least 20 years. We have an actively managed high conviction equity portfolio. We have a good performance record, which I'll show you in a minute. We have a low management fee. We charge 0.35% on gross assets. And importantly, we, as an investment company or investment trust, we have an independent board of directors there for the shareholders, comprising 2 people who are formerly investment managers themselves, including the chairman who was the chief investment officer at Fidelity International. And we have 3 other directors who are more on the commercial and industrial side, and one who's got a background in the media industry. So there's an experienced board who are there to represent the interests of shareholders. I talked about the track record of raising the dividend every year for 35 years. We are immensely proud of that record. And what I'm showing on this chart is not only the dividend every year for the last 35 years, but I'm showing the little green bars where the earnings of the company were above the dividend. The directors put away money into reserves in the green years, and the red bars where the directors had to dip into the reserves to continue growing the dividends. So 2008, 2009, we had some significant income, and much of that was put away, or some of that was put away into reserves to allow the directors to keep growing the dividend every year, particularly in 2010, 2011, when they had to dip into those reserves. As we sit here today, or stand here today, for the last 4 or 5 years, the earnings have been broadly covering the dividends again. And actually this year we're seeing quite good growth in UK dividends, helped of course by the depreciation of sterling, because much of the income comes from overseas or is paid in US dollars. There are still significant reserves remaining. At the end of the financial year there were 22.8 pence per share, which is almost a full year's dividend in reserves. The second objective of merchants, as well as paying a high yield, is to deliver a good total return. This chart here simply shows the net asset value total return compared to the benchmark. The benchmark used to be the FTSE 100. We changed it, or the board changed it at the end of the last financial year to the FTSE All Share, but we show the composite benchmark over that period. And the trust has performed significantly above the benchmark over 5 years. So that's the second objective, is to deliver a good total return, a good capital return. So how do we set about choosing stocks in this market with so much uncertainty and so many factors we can look at? We really look for 3 things when we buy a company. Really, we ask 3 questions. The first question is, how good a business is it? The second is, how cheap is it? And the third is, what's going to change? So by how good a business, we look at the fundamentals of a company. This is everything you'd expect us to want to understand. How attractive is that industry? How strong is the competitive position of the business? How good are their brands and their technology and their processes for making products or selling services? How robust is their balance sheet, financial situation? And how are the board of directors, how's the chief executive incentivized? What are they motivated like? What's their track record? How strong is the governance structure around them? Everything you'd expect us to ask. Second question, fairly straightforward. How cheap is this company? How cheap is it compared to its history, compared to other businesses in the sector, compared to other companies we can buy in the market? And all of those factors come together. In particular, we look for a good dividend yield, but the dividend yield never drives the investment decision. We're always looking for companies we think can make money rather than just paying a good dividend. But the third factor, I think, is in some ways the most tricky to understand, but possibly the most important. It's what's going to change. Life is dynamic. We are seeing a huge rate of technological change in the world and massive cycles, economic business cycles. So we ask ourselves, what's going to change? How is technology going to affect this business? And because we're value investors looking to buy good companies at sensible ratings, the most important thing is you don't find a company that looks cheap but is cheap for a good reason. So we try and identify those sort of structural pressures, and equally we try and take advantage of structural opportunities. But also we want to understand where we are in the business cycle, where we are in the industrial cycle. One example I can give you to put all this together: Kier Group, a leading construction company in the UK. It builds buildings clearly in construction. It also does construction services, particularly for utilities. It has a housing operation which is very strong with local authorities, and it has a property business which does non-speculative property. For example, it has an exclusive deal with Network Rail to develop any of the assets on the sides of railways, any of the land. If Network Rail want to develop something, Kier always have the exclusive right to work with them, which is great because they don't put up the capital, they put up their expertise. They can make a good return on capital, but it's a relatively low-risk way of going about it. So it's a good business. A lot of their construction is on framework contracts with local authorities, relatively small contracts, relatively simple contracts they've done before, but in a controlled environment. They have a leading position in the highways England. As you can see from this chart, they operate in, I think it's 5 today, five areas, and they have done some of the other areas in the past. And Highways England places a high premium on quality, on safety. If you imagine working on the motorways, the absolute most important thing is that you are safe and secure, and health and safety is paramount. Price is obviously important, but is not the first factor. And IKEA have a great record on safety and reliability, and that has a really good position with Highways England. So it's a strong business. They have strong risk control, good management, and a robust balance sheet. What debt they have is backed by the assets in the property business and in their infrastructure side. It's definitely cheap. Many construction companies have had problems in the UK, and Kia is lowly rated because of the industry it's in, not because of their own track record. It's on an 11 times price earnings ratio, 5% dividend yield. So the valuation is quite easy to understand. And then thematically, what's going to change? Well, 2 things are changing. Firstly, governments are committed to infrastructure, whether you look at the US, but particularly in the UK. We've got the 3 H's, Hinkley Point, HS2, and Heathrow third runway, which are, Hinkley Point's already in construction, but others are coming. But we're talking about a lot of investment from the government, partly to offset the risk from Brexit. We're also seeing a cyclical recovery in construction, and that's more about the price and the terms of the trade. Balfour Beatty have pulled out of a lot of local, regional construction, and there are less people who can do it. And that means that as the economy is recovering and demand is picking up, they're getting better terms for the deals they're doing, better cash terms as well, which is important. There's a big shortage of housing, and Kia can work with local authorities and convert their brownfield land into new housing developments, which could produce both sheltered housing, council housing, as well as private housing. And again, that's a relationship that not many companies can do. So there's quite a few thematic areas that are helping the business as well. Just moving on a little bit, conscious of time, I've got a few minutes left. How do we see life today? Well, I think the general election, which was a bit of a surprise to us, probably will result in a increased Conservative majority, although they seem to be doing their best at the moment to try and avoid that. Brexit uncertainty, though, will continue for a long time, particularly the trade relationship of the UK with the rest of Europe and the rest of the world is going to be uncertain for many years. And I think investment and consumer spending could be affected by that. However, I think fiscal spending will help. I talked about that a minute ago. Also, interest rates are likely to stay quite low. The good thing is companies are in good shape. And of course, the UK stock market is not the UK economy. 70% or so of earnings and revenues in the UK stock market come from abroad. You can invest with UK corporate governance standards, UK takeover panel, legal framework, but you can invest in businesses and industries around the world. And I think that's a good combination. We think that dividend yield is going to remain an important factor. And where we see best value today is in some of the mega cap companies that we've liked for a while, selectively, which are still quite cheap, the big oil companies, Glaxo, HSBC, and some of the recovery situations where investors are nervous about the short term and aren't looking forward 2 or 3 years into the future where we see significant value. And the corollary of that, or the flip side of that, is companies where the earnings are pretty secure or perceived to be secure are often really highly rated today. And you can think of a number of companies like Reckitt Benckiser, Unilever, some of the tobacco companies, Compass, Bunzl, some of the names I mentioned earlier. We owned most or all of those companies a few years ago, but today we find very little value in that part of the market. The next page is simply some of the themes. I haven't got time really to talk through these in detail, but if we can find, just one example, if we can find, we think emerging markets, thematically, you are going to see more growth in spending in emerging markets, and where you can get exposure to emerging market companies at a sensible price. That's really interesting. So Prudential, which sells life assurance in Asia, or United Business Media, which has a big exhibition business in China and Hong Kong. I think that's quite interesting. You're not paying any premium today for those exposures, whereas a few years ago you did. So those are the type of themes we are looking at in the portfolio. Overall, when you look at how we're positioned, I should say, first off, when we buy companies, we start by looking, do we think this company is interesting? Do we like the industry? Rather than saying, where is the index? Where do we want to be around the index? But we do obviously end up with positions different to the benchmark, different to the index, and people want to know how we're positioned. The biggest views we're having compared to the benchmark is we quite like life assurance and utilities are two sectors that offer good dividend yields, but also dividend growth, good dividend growth. And that's a nice combination. And then the other sectors, construction and materials, travel and leisure, financial services, it's much more about the individual companies. We do like the construction industry generally, but also it's about the individual companies. Travel and leisure, I mean, we own companies like First Group, Ladbrokes, Carnival, and there's really very little that puts those that links those companies, except they all happen to be in the same sector. Where we have very little invested is tobacco, household goods, personal goods, some of those areas that are pretty expensive, as I said earlier. And if we don't have a positive view on a company, we just won't own it, no, irrespective of how big it is. And you can see some of the individual companies that we have the biggest active positions in: Glaxo, United Business Media, Inmarsat, Standard Life, and Tate & Lyle. So just to summarise, the Merchants Trust has a good performance record. We are active managers, we take strong positions, and we do move them around because we're value driven. And the valuation will determine the type of companies we want to own over different periods of time. We have grown the dividend every year for 35 years, and we're very proud of that, and put a lot of emphasis on continuing to be able to do that. The high yield is supported by significant reserves, and the management fee is very competitive. It's the lowest, joint lowest in our sector. And so we believe Merchants is very well positioned for the future. And with that, I'm very happy to take some questions.
Any questions, anybody? Well, I've got some. Right, here we go. Obviously, we're in a low interest environment. Do you find that the companies are trying to preserve their capital rather than distribute through dividends, and does that affect you directly?
That's a good question, actually. I'm not sure that's. I don't think many companies want to sit on capital. I think they'd like to invest, but many companies can't find that many investment opportunities. So they're returning. A lot of businesses are actually returning companies capital either by dividends or by buying back shares and gearing up. So if you look at, a classic example, Unilever, which got bid for by Kraft Heinz and Warren Buffett, and obviously rebuffed that. In response, they're actually giving money back to shareholders and gearing up. British American Tobacco and Imperial Brands are tobacco companies which historically didn't have that much debt. Now both have 3.5 to 4 times net debt to EBITDA. So companies are struggling to find, and that's not because they found fantastic investment opportunities. They may have bought businesses. Bats has bought Reynolds in the States, but Imperial's just been gearing up gradually over time and paying big dividends to shareholders. So I'm not sure they're sitting on cash, but I think they're generally giving it out.
Where they can, or as you say, buy back, which obviously you see a lot of those announcements now, buybacks, don't you?
You are, and some of that is motivated by earnings enhancement and the cheap cost of debt. And it's interesting to read the Conservative manifesto because they're looking at whether managers of companies have benefited from earnings enhancement by simply buying back shares rather than by investing in growth in the business, which is quite interesting to see a Conservative government talking about those sorts of things.
On the chart you showed about the dividend distribution, you was one year, was it 2008, 2009, where you did a special dividend?
Yeah, I can show you that.
At what point do you come to and decide, 2009,
yeah,
just after the crash, what point do you decide you've got sufficient cash to do a special? Because obviously you've almost covered next year already with your financials.
Yeah, it's a really good question. Our year ended January, so the year to January 2009 included the bank's final dividends for 2007, which were paid in about March, April of 2008. So you've got to think of where you were at that point in time. At that point in time, it was very clear that those dividends we'd got from the banks weren't sustainable. They were going to be cut. They've already announced it pretty much. And yet we had a lot of income coming into the trust. Now under the law, you have to distribute at least 85% of your income. Right. You can only put 15% away into reserves. So the directors had to distribute more than they really wanted to distribute in dividends. And so in order to do that, they paid a special dividend of half a penny, which allowed them to keep the ordinary dividend at a level that they knew they could continue to grow, rather than setting too high a bar by having to pay out
So it's a requirement rather than a wish to do something on your own behalf. It was a requirement.
Yes, it wasn't
had
a
to
wish to distribute surplus capital. It was a requirement that they had to give out a certain proportion of the income, and they could tell at that point, and we could tell that income was going to be much harder to get post the financial crisis.
And what are you trading at discount-wise to net asset
It's about
value?
4 or 5% at the moment.
It's quite small, isn't it,
It's pretty
compared with
tight,
some of the
yeah.
investment trusts out there. And finally, this is a performance of your dividend. How's the performance in terms of the capital? The share price in the marketplace.
Yeah.
How's that performed?
Well, I showed you the 5-year chart.
Yeah.
We've done pretty well over the 5 years. Over the last year or so, it's been more difficult. The market's been extremely strong and propelled by a few sectors, particularly the mining sector, where we're underrepresented. So we didn't quite keep up with that at the portfolio level, but at the asset value level, because of the gearing, it's been all right. And certainly compared to our peer group, the last 12 months we've done quite well.
And finally, I noticed on some of the companies you got Mothercare in there twice under two different sort of things. Can you explain your choice behind Mothercare, which in many people have thought is a bit of a basket case? Clearly, you can see something that potential growth out of. What's the story behind Mothercare for you?
Well, the story behind Mothercare, and it's been in there for a long time. Well, I should say that these aren't exclusive categories, so you can be.
They're going to say you
can be a turnaround situation and have emerging market exposure. Yeah. And when people think of Mothercare, they don't think of emerging markets, but actually the vast majority of stores are franchise stores overseas, particularly in the Middle East, in Eastern Europe, and even in China and India and other countries. And in those places, they are seen as a premium retailer, actually, rather than a very low price retailer. So the value in Mothercare has always been in international operations. The challenge has been turning around the UK operation. It's taken them a long time. The management team have done a quite good job, actually, of improving the UK operation. But it's been a slow burn, and they've just announced a couple of weeks ago that they're actually they're going to go even further. They've halved the size of the UK store estate to 150. They're going to take it down again to 80 to 100 over the next few years. So this isn't a quick fix. There's quite a high level of risk, but there's enormous value in the international franchise operation. And so it's one of those situations where I think there is long-term value, but certainly the short-term is quite risky, I suppose.
I suppose on the UK retail estate, it'll be as leases come up, they'll probably more come out of
their average lease length is 5 years, so they have worked very hard to get the average lease length down. But the reason it's thematically a couple of interesting, because it's a big emerging market earner, and it's also a management turnaround situation, which we quite like in general.
Anybody else got any questions at all? No? Thank you very much, Simon. Thank you.
Thank you.